Hello and welcome everybody to this latest weekly market recap for the week ending Friday, December 27th, 2024. Of course, just a few days away now from a new year. Kind of hard to believe 2024 is almost over. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. Pleasure to be with you again this week. Hope everybody's enjoying the holiday season. This is typically when we get that Santa Claus rally, but as I show you in just a couple minutes, today was certainly not part of a rally. That was for sure. We did have a lot of weakness this morning, followed by a little bit of a recovery throughout the rest of the day, but still not a very good day. But we'll go over that in just a minute. Earlier this week, we're not getting a whole lot in terms of economic reports out, or we haven't had many out. But we did see durable goods earlier in the week come in below expectations, as did consumer confidence. New home sales actually met expectations. And then yesterday we got initial jobless claims out, and they came in just a little bit below expectations. So the economy seems to remain somewhat resilient, but we've had the 10-year Treasury yield continuing to move up. I think that maybe that's spooking the market a little bit as it continues just to meander higher and higher up towards key resistance, first at 4.70%. And then ultimately, I think 5% would be maybe a psychological level that we'd want to watch to make sure we don't go through that. But let's take a look at the action first from Friday, and then we'll talk about the rest of the week. You see the Dow Jones Industrial Average down 333 points, S&P 500 down 67. That was more than 1%. NASDAQ, and down below here, NASDAQ 100, you can see the NASDAQ down 1.50%, NASDAQ 100, which includes a lot of the Mag 7 stocks, down 1.36%. So maybe a little bit of outperformance in terms of the Mag 7 relative to the NASDAQ as a whole, but still not a good day at all. Small caps down 1.3%, mid caps down almost 1%. So it was across the board. The only thing you see green here is really the volatility index, which is normally not a good thing. We don't really want to see volatility spiking, certainly not through key levels. The first one I would look for is 17. I think a bigger level is up at 20. The volatility here in the month of December has been very, very strange. We don't normally see this kind of volatility because December, I think over the last 75 years, has been up probably around 50 or 52 times, which makes it, I think, the month that has gained more often than any other calendar month, dating back to 1950 on the S&P 500. So usually volatility tends to drop off in the month of December when we tend to have strength throughout the holiday season and all, but we've gotten a lot of back and forth on the VIX. So that's something I'm keeping an eye on. Anytime that VIX is up above 20, that's telling me that the market's very nervous, and we don't want to see bad news come out when the market's nervous, because it usually leads to some pretty substantial selling over a fairly short period of time. So that's something to keep in mind as we go throughout the rest of this holiday season and then into 2025 as we start off January. But let's take a look. I want to go through and look at all the major indices on the daily and then the weekly charts, just to give you an idea of maybe how we can keep things in perspective. Because if you look at the daily chart here, there's no doubt in my mind the Dow Jones is in a downtrend. I mean, we've gone down, crossed both the 20-day moving average and the 50-day moving average. We've gone back up, failed at both those moving averages, and started to roll over again today. So this doesn't have a great look. As I look at it, I would watch this gap support level from early November. That was right before the election. We've got the bottom of gap support that comes in somewhere around the 42.2 level, 42,200 on the Dow. We got down to that level, put in a nice bullish engulfing candle, and that's when we got the little bit of a rally. I think if we go back down and lose that level, the daily chart anyhow would begin to just look a little bit more bearish in terms of trending down below those moving averages. As I look to the S&P 500, it's not as bad as the Dow, but there's a couple things to watch here. The first thing that I would keep an eye on is a potential head and shoulder pattern. So we got a left shoulder coming down to the neckline here, back up to the head, back down to the neckline again, the right side of the neckline, and then back up into a right shoulder where we were unable to pierce the 6,100 level. But we started like on the Dow, it looks like we kind of rolled back over again on Friday and started to see a little bit, maybe more of renewed short-term selling. So I would watch this neckline very closely. And then, of course, the gap support from that election just below 5,800. So those are the two levels. I would say maybe about 57.80 to maybe 58.30, somewhere in that range. I would watch pretty closely. If we lose both those levels, I think that would obviously start to show much more short-term bearish action on this chart. Moving on to the NASDAQ 100. This is this chart looks a little bit better and more constructive because we went down, we got a nice reversing candle about a week ago, right above the 50-day moving average, moved back up fairly close to the highs, pulled back, but at the close today, we were right on, or basically right on the 20-day moving average, closing at 21,473 with that 20-day moving average at 21,430. So actually just a little bit above the 20-day moving average. So I find this chart here to be much more constructive. And the low that we saw a week ago didn't go all the way back down to that low that we had seen back in mid-November, like the S&P. So if we go back to that S&P, see this low right here, and we've come back down to challenge that low. When you look at it on the NASDAQ 100, we're way above that. So while the NASDAQ was showing relative weakness there for a while, in the most of the fourth quarter, we're actually starting to see on a relative basis the NASDAQ do much, much better. Next up, IWM. This one shows the most weakness after going back below its 20-day moving average. It's really struggled to get back up above that. And again, there's your death cross where the 20 comes back down below that 50-day moving average. So obviously on this chart and that gap support level from early November has been lost. So yeah, we rallied back a little bit and then started to roll over again. So, small caps definitely look a little bit worse to me than what we're seeing in other areas of the market. In the short term, longer term, I'm still not sure about small caps. I'm going to continue to watch. We definitely do not want to go back down below relative support areas from back in July. That's when the IWM first took a big move to the upside. So I'll be watching that area pretty closely. On the mid caps, pretty much similar to the small caps. Big breakdown here. We see that death cross on the moving averages. A little bit of a bounce coming off the support at the beginning of November. But again, Friday, we saw a little bit more weakness kick in again. And don't know if we're rolling back over into a more substantial period of selling. But at least it did break that short-term winning streak that the mid caps had of 4 days in a row closing higher. We did break that streak. Transports, this one's the worst looking of all. And this is one that you can see the death cross occurred probably a week and a half ago. And the selling hasn't accelerated off of that, but we've really had very little rebound in the transport stocks. Now, the next thing I want to show you, so those were all the daily charts, and they don't look great. NASDAQ looks the most constructive of all of them, but really they look like they're trying to roll over. Now, this is where perspective comes in. I think we need to, kind of take a step back and let's look at a 3-year weekly chart, because we go through periods of selling on the daily chart that doesn't look very good. But then when you walk away, you back up and you kind of, look at the bigger picture. I think things look much better. And so here's the Dow. I mean, all we're doing is what we've done throughout, much of 2024, which is go down, test the 20-week moving average and bounce off of it. So what we've seen so far here in December, even though it looked really bad on the daily chart, it doesn't really look much different than what we've seen throughout 2024. And in the past, in 2024, we bounced off this level and moved back to new highs. So that's going to be one thing that perhaps gives the bulls a little bit of hope as we wrap up 2024 and move into 2025. But I do want to see this area of the chart hold up as support. S&P 500, same thing. Not this week, but last week we went down, tested that 20-week moving average. And if we go back throughout 2024, we never had one candle. We didn't have one weekly candle that closed beneath that rising 20-week moving average. So this is week 51 out of 52. And look at us. I mean, we're still sitting above that 20-week moving average. So it's been a pretty constructive year for the markets overall. I think just about everybody would agree there. So pulling back from time to time is really not that big a deal. Then we get into the NASDAQ 100. We did have a reversing candle here. It's a bearish engulfing candle from last week. And then this week, we just kind of traded within a range. But overall, I would say the NASDAQ remains solidly in an uptrend. Then we look at the small caps, IWM. We actually did close a little bit below the 20-week moving average, which we have done in prior periods. But what I do see when I look at this chart is a channel going up off of the low from 2023, very end of the year where we had that triple bottom. Since then, I think we've got a nice little channel going, and we're kind of getting down to a point or close to a point, maybe 215 would be the level, where I think we'd be testing the lower channel line. And so again, if we're looking at the long-term trend, I would say that this weakness is setting up an opportunity for a big bounce, perhaps in the IWM. But there's a lot to still consider. I mean, we don't completely ignore those daily charts and the breakdowns there. We need to see recovery there as well. But I do think these weekly charts that we're looking at provide us a lot more hope that this market's going to rebound and turn back to the upside. Mid caps, I would say the same thing I said about small caps. I think we have a nice little channel in play, probably testing it right about now on the mid caps. And you've got some pretty good support coming in between probably 3,050 and 3,100. I would watch that area. And then transports. Transports couldn't have looked much uglier on the daily chart. But if you look at the weekly chart, we could go all the way back to 2022 and connect these lows. And we've got a pretty nice test of a 2-year channel line. So transports, if this move on the interest rates to the upside is just temporary and we come back down, this could be an area where we make a big bounce on the transports. At least that's one scenario that I'd be kind of watching closely. All right, I wanted to move into the sectors because the sectors here are really interesting. So what I've done here at the top of this chart, this panel right here in the middle of your screen, is I'm showing technology, the XLK, relative to the S&P 500. So when this goes down or when it goes up, doesn't necessarily mean technology is going up. It means that the relative strength is going up. So it's outperforming the S&P 500. Well, if you look here for the last 5 months or so, we are going sideways. We're trying to get back up to what would be about a 5-month relative high. If we can get the XLK to continue outperforming and we get through 0.04, that would take us back to the highest relative level on technology since all the way back in July, toward the latter part of the second half of July. So we'd be talking about a solid 5-month relative high. We don't have much further to go. So technology is holding up. Now, if I look at consumer discretionary, here's consumer discretionary. Look at the relative strength here. We've had a little bit of a pullback, but this group has been absolutely on fire. And then you go to communication services, same thing, strong. Those are the 3 most aggressive groups. And they're leading. They've been leading here for the past couple of months, 2-3 months. And some, the discretionary, even a little bit longer than that, I think was showing. Yeah, going all the way back to this bottom in August. So that's about 4 months. So we're definitely getting leadership from aggressive areas of the market. And so for those who think that inflation is likely to be a big problem or that we're heading for a recession, that's not what the market's saying. That's not what these charts are telling me. So, you can listen to what's going on in the media and the fact that the market, has struggled in December. That's fact. I mean, I can't argue that. December's not been a good month. But we're not seeing the rotation. We're not seeing the signals under the surface that would suggest that this is anything more than just a short-term pullback in the market. So it kind of favors what we were talking about in terms of the moving average, or the major indices on the weekly charts holding on to those key moving averages like we have throughout 2024. This is a chart, or these first 3 charts I show you in the sectors, help to support that theory. All right. After we go through those 3, look at industrials. Just falling apart here in December. Financials starting to turn back up, but it's been a rough December for the financials as well. And then once we get out of the aggressive areas, because financials and industrials I also consider aggressive, but they're not usually big outperformers of the S&P 500, except in the fourth quarter of the year, which is what we've seen throughout much of this fourth quarter until December. But all these other groups, I mean, let's take a look at this. Just focus on this top chart. This is healthcare, completely underperforming and has been now for 4 months. Staples, there was your relative high back at the beginning of September. Continuing, I mean, just recently posting a 52-week relative low. Again, if bad things were coming, money would be rotating into these groups, not out of them. Real estate, another defensive group. Look at the last 4 months, horrible. Utilities, last 3 months, trending lower. Energy, down at a 52-week low. Materials, 52-week low, relative low. So all the defensive groups and the neutral areas, or I consider them neutral areas, materials and energy, because they tend to perform more with, maybe geopolitical things going on and what's the dollar doing versus, the commodities and, so forth. So those are some of the things that, the economy doesn't really control. I mean, it does to some degree. Anytime the economy's stronger, we're going to see oil prices generally go up, energy generally go up because of the demand for energy. But they can move kind of crazy. And so I don't really use them to try and help me decipher what's taking place in the market. But I think as you look at all that, this isn't a market that looks like it's setting up for a big drop to me. There's no, Wall Street, if it's a big drop from here, Wall Street's going down with us because they're not moving, not like at the end of 2021. Remember December? Actually, I'll show you December 2021 in just a minute, right before that 2022 cyclical bear market. So let's take a look at the RRG, looking at these sectors. And what I want you to notice here is, first of all, this area right over here, the right side of the RRG is, it shows relative strength. And I highlighted the 3 sectors that are in the, better relative strength area now, or have been all year, or at least for quite a period of time here. And look at where we're sitting over here on the right side. And what's leading? XLK, XLC, XLY. So I showed you on the charts how you can do the price relative to kind of get a feel for what's going on in the market. This is another way to visualize it. I mean, it's brilliant. My good friend, Joyce DeKempenaar, founder and creator of these RRG charts, found a way to, I mean, it's a genius way to visually see what is rotating, because this center right here is the S&P 500. So when you're leading the S&P, you're over here. When you're weakening, you're here. But a lot of times what you'll see is you'll kind of go, into the weakening and then turn back up into the leading kind of a thing. So anyway, what I'm seeing here is just relative strength in these 3 areas. And again, this is 20 trading days ending December 27th. So basically the entire month, it's 20 trading days. It's not 20 calendar days. So 20 trading days pretty much takes us back to the beginning of December. So you can see what's happening in December, how we lie over here on the right side of the chart. Now, I went back and I looked at the 22 trading days ending December 31st, 2021, right before the secular bear market. Notice we were going up. We were still setting all-time highs then. But look at the money that was rotating out of the XLK, XLY, and XLC. See how all the action is now taking place over on the left side of the chart? That means Wall Street is completely rotating out of the aggressive areas and into the defensive areas, which now are, if you look at the under side of it, the other way to do this, I guess, is just to, let's get rid of those. And let's look at the 3 at the top: healthcare, real estate, materials. This is what was leading at the end of 2021. Do you see the difference? So again, for me, it's all about, For me, it's all about the under the surface signals when I try to call the S&P 500. This is not setting up like it did in 2021. Not from a sector perspective, not from a rotation perspective. We still got money pouring into technology and consumer discretionary and communication services. That to me just doesn't make sense that that would happen right before a big drop in the S&P 500. Maybe I'm wrong. I'm just giving you my opinion and just looking at the market here. 10-year Treasury yield. This is something I'm going to watch in 2025 because I do feel like we've now been consolidating in this 3.5% to 5% range for quite a while, a couple years. I mean, this was maybe just below 340, but we could go back 2 years and everything on the 10-year Treasury yield has been between 340 and 5. We're in an uptrend. We're sitting at about 4.6 now. If this were to go up and break out above 5, there's probably a reason for it. I've said I don't believe inflation's a problem. I think the economy is remaining resilient. But if we get this breakout above 5%, the bond market's telling us something different. And at that point, I'm probably going to start paying more attention to that. If you look back at the end of 2021, we had started seeing the interest rates rise, kind of like what we're seeing here into year end. But in 2022, we broke out and we had a huge, through that entire cyclical bear market, we saw interest rates climb a lot. And so again, that's why I would be paying attention to see whether or not we break above 5%. I think we'd probably be okay to 5, 5.5, 5.25, but I just think psychologically going through 5 would be a problem for the market. So that's something I would be watching. All right, want to mention to everybody, we got Market Vision 2025 coming up in 1 week. If you go over to earningsbeats.com and you click on this link right here, Market Vision 2025, this will come up. You will see everything. We're about to post the agenda for the event. That'll probably be coming up early this week. The year of diverging returns. And I'll explain a little bit more about that at Market Vision 2025. But we have had some unbelievable calls. We've been doing this. This is going to be the 6th one for us. So we did it in 2020, 2021, 2022, 23, and 24. So we've had 5 of these now. This will be our 6th one. And I thought we were going up in 2020. We went up in 2020. I thought we were going to keep going up in 2021, even after the pandemic. We kept going up in 2021. In 2022, I said I thought in the first half of the year we could see a cyclical bear market. First half of 2022, we saw a cyclical bear market. 2023, I said we were going to go up. I said early in the year we'll be hesitant. There'll be some choppiness. We had a little bit of choppiness, and then we finished up strongly, balance of the year. I said, around 4,700. We closed at 47 and change. 2024, I thought we were going higher, but I didn't think we were going as high as we went. So I was off a little bit on that one. However, I'm okay with that. If I get the direction right, I'm going to be pretty comfortable with my trading and hopefully my trading results throughout the year. So anyway, 2025, this is going to be a crazy year coming up, in my opinion. Got a lot of thoughts on it, where we're headed, but check this out. You can sign up here. Make sure you register. And by the way, if you register and pay for the event, you get our annual membership for free, completely free. And the amount, you actually pay more for an annual membership. So you're getting quite a value by coming to the event. All of our annual members at Earnings Beats come to the event free. So if you sign up for the event, we're going to give you an annual membership. Just give it to you. You'll have it for 12 months, all the way through next year. You can follow along with all the research and everything that we do. I think it's a great opportunity to get on board with our membership at a very, very, very reasonable cost. And essentially, look at it like you're joining as an annual member and you get the event free. Either way, it's a great deal. So make sure you check that out. If you are on a mobile device, well, we've got a screen up for you. There is a QR code. You scan that. It'll bring you right to this page. You can sign up on your mobile device and make it as easy as we can for you. All right, let's talk a little bit, this opportunity, if I'm right, and this market is just pulling back and we're going to go back higher again, then I think it's important to look at some of the areas that are strong and maybe look really solid on their charts. I think internet's one of those groups, and internet tends to like the month of January, which is right around the corner. But we had an uptrend. We followed it with looks like a little cup handle and a breakout. So this 4,800 breakout on internet would measure from 4,800 down to about, let's just call it 4,000. That's 800 points, would take us to 5,600. That would be the measurement. We're sitting at 5,048. So there's still a lot of upside potential in internet. So what I did is I ran a scan. Actually, internet was one I was looking at. The other one was software. Let me show you software as well, because software pretty much did the same thing. We had this nice trend up. We went sideways throughout much of 2024. We made the breakout and we are trending up. Look at the pullback and test the recent low and the 50-day moving average. I actually liked this one a little bit better than the internet because we came back a little bit further, the 50-day instead of the 20. And so that's why at the last minute I changed it to software. But what I did is I looked for RSI that was less than 60. So that means you've had to have had a pullback on individual stocks. Scooter, though, is above 80. So it's got to have a stock that's got some relative strength. And then I ran this scan against two of our key chart lists that we keep at Earnings Beats: strong earnings and raised guidance chart lists. So if it's a company that's beaten Wall Street estimates as to both revenues and earnings, is liquid and also looks good technically, it'll be on our strong earnings chart list. And then raised guidance is essentially any companies that are raising guidance that are liquid. And all of these chart lists, if the stocks need to be over $5. We just don't look at smaller stocks. I mean, that's fine if that's your preference. It's just not one of our preferences. Anyhow, we ran this scan and it came up with 28 software stocks. And you can see some of them, and I showed the 1 month return. So this is showing how the return is. Over here on this far right-hand side, if you go under columns, you can see this EMA 20. If you've checked that off, it'll come up over here and it tells you where the 20-day EMA is and then where current price is relative to the 20-day. So on Asana, for instance, price is about 1.74% above the 20-day moving average. But if you look at some of these, they're going to be like right here, Fortinet. It is basically sitting right on the 20-day is 96.03. The stock's at 96.08. So you know you're getting a 20-day test. It's just a way to kind of maybe speed up your process of looking for these pullbacks in these software stocks to give you some opportunities. Anyway, that is essentially what I have for today. Really appreciate you tuning in. Please come join us at Market Vision 2025. I think it's our best event, and I think it's the most important event that you're going to find in 2025. Get an idea of what the market is most likely to do in 2025 before it happens. And that way you can set up your trading or investing strategy accordingly and try to make the most of the market in 2025. Anyway, everybody have a great weekend. Enjoy the rest of your holidays. Be safe out there. And let's look forward to a bright 2025. Happy trading, everybody.